what was the moment you realized this is not my long-term life, right?
I would like to say it was an overnight decision. I'm the type of person that I have to learn a lesson over and over and over and over again before I'm like, oh, that's what you meant by that. But working 9 to 5, for somebody else and their priorities and their dreams.
What makes her truly stand out is not just the deals, right? Is the spark, the clarity, the courage, and I will say the conviction to build wealth with purpose. And this is a kind of women we love to invite in our Spark Show. And we are proud to invest in women like her. When that kind of energy aligns, it's not just a portfolio that grows, right? It's impact, it's freedom, and it's legacy. And I'm especially pumped to have her here today. Welcome to the show, Whitney. Whitney, how are you today?
I'm doing great. Thank you so much for having me on.
You're an exceptional woman. I heard so many great things about you, and I'm like, I need to meet this girl. You earn a PhD in community health and nutrition, Whitney, but something pulled you off that traditional academic path. So I wanted to know what was the moment you realized this is not my long-term life, right? I need to build something different, meaningful.
I would like to say it was an overnight decision. I'm the type of person that I have to learn a lesson over and over and over and over again before I'm like, oh, that's what you meant by that. Um, okay, so sometimes I can be a little bit of a slow learner, maybe surprise for somebody with my educational background, but my real estate journey starts off in 2002. I buy a house with a significant other. Relationship falls apart a month later. I was the money partner. Everything was under my name. At the same time, I think a lot of people, if you listen to other podcasts, you hear this part of the story.
Yeah.
It falls apart. Green shag carpet, psychedelic daisies painted all over the walls of this house. I have to learn how to put it back together using Home Depot resources, like all the free classes, the one Home Depot 1, 2, 3 book. The part of the story that I don't go into that often is my dad's at home. He
Oh,
he's at home in Houston. I didn't know at the time that I only was going to have like another 2.5 years left with him. He had Parkinson's. He was very ill, and at this time, I'm working my public health job that has me traveling 70, 80 hours a week. I can't take a vacation to go see my father. I mean, I'm just like, what? Why am I doing this? And so I'm rehabbing this house. I'm thinking my head is underwater. Like the puppy is drowning right now. And so I sell the house. And then end up with this check at the end. And then when I do my taxes, I realize, okay, I didn't just make $52,000 tax free.
yeah.
I also hadn't been paying for my real estate living in my house, none of my living expenses for 11 months. So I'm really kind of frustrated because now uh I clearly can start seeing that there are other things other than public health that will allow me to have that time freedom that I want. I wanted to spend time with my father, right, before he passed away. And so that was kind of lesson number one. So I started building a coaching practice on the side, right? Nutrition practice and a personal training practice, which I eventually sell both. But that was like lots of time, grueling time. Entrepreneurial life, I'm sure somebody's listening here is not all the first few years of that is like just total grueling work before you get to start harvesting the fruits of your effort. I start fix and flipping. And so I'm constantly getting these like little checks, right? Because the first deal went so well. Second deal, not so well. Okay, I barely broke even. Three and four go really well. So I'm doing well here, but I still can't connect the dots of how do I get the financial freedom? All I knew in that first transaction was there was a different way than being in in a corporate role. And at this point in time, it's public health, not corporate yet, but in, working 9 to 5, for somebody else and their priorities and their dreams.
As I'm listening to your story, I feel so connected because for me, it was pretty similar. My mom got cancer, and I could not just travel and leave my corporate job to take care of her. And I remember reading the Purple Bible, the Rich Dad Poor Dad book. I noticed that we were in that same kind of training, and it just told me like there has to be a different way. And I got a property too in Burbank, California, did very well. And to your point, I made that decision that I wanted something different. But the freedom to walk away from the safe pad and building something of their own. As you go through this journey, what kind of shift happened in your mindset to get there, and how that mindset has evolved from the single family home to now I own, or I'm part of $800 million portfolios?
It was just like to earn money so I could support my life. That's it, right? Put food on the table for my family, take care of my daughter, take care of my husband, right? That's really all I'm doing at this point in time. But in the background, I continue to do these real estate transactions. Somebody said to me, a friend of ours that had done several rentals, they were like, "Well, Whitney, why don't you put a renter in that property and not sell it?" I was like, "Whoa, that's brilliant. Like, why don't I do that?" So scaled 40 single family rentals. It was ready, fire, aim. I mean, I just flipped the switch and my husband, it was blinding the first year. We closed 10. The next year we did 30.
Wow.
So we scaled this portfolio, but I'm still thinking I have to do everything myself. How can I elevate myself out of this business? And it was then that I realized, oh, I got to get a partner in some form or fashion. So what do? I hired my husband into the business because he wants mountain bike. He wants money so he can go mountain biking. I'm going to hire you and you can take over all the finances. It was the best thing that I could have done and the worst decision I could have made because the best thing was I realized at that point in time I need partners in order to start elevating my business. But at the end of the day, he was like, I hate it. I'm like, I hate it too. And so I quote unquote fire him. And dinner was funny that night because I was like, "How was your day?" And he goes, "Well, my boss was a jerk and fired me, but other than that, it was fine." I was like, I'm kind of like, "Oops." But I guess that was the next mindset shift. I can't do this alone. I need to be in partnership, whether that's a money partner, a deal partner. I'm like, okay, do I do this actively or passively? Okay, so I do both. Why not?
Yeah.
Let's go buy a 52 unit apartment building with a couple partners. And then I'm still investing our cash flow and our equity harvesting into passive deals. I'm standing in line, go to my first real estate conference. There are
Mhm.
10 women out of 600
Yep.
at the conference. And I actually met my two partners that I go into business with first. They were like, "Hey, we're looking for an executive assistant." And they were like, "You have a strong operational background. Can you help us out?" I'm like, "Sure, no problem. Give me the resume or the job description. I'll take a look at it and help you with my network." And then at the end of it, I'm like, "Well, I can do all that." Like, they're not looking for an EA, they're looking for a director of operations. And so I'm just starting, this whole world is opening up to me. Like, how does somebody take down a 150 unit apartment building? There's not just one investor, it's a group of investors. And so I'm like, oh, everything is in partnership. Nobody does anything alone. There's always an investor. So that was the one of the major mindset shifts of like, how do I learn about partnership? And the last lesson I had to learn there was like, you don't have to use all of your own money in order to create wealth. You can partner. There's power in partnering with other operators, with other passive investors in order to get pieces of deals.
I just want to jump in and start unpacking because I think you went through the biggest hurdles first, partnership, because I have seen a lot of people that they tap in the 30 and 40 properties because they forgot that although they might have property managers, someone needs to manage the assets and the property managers. But to work with a significant other requires so much communication, and there's other type of conversations. What are the key factors that you look into a person or a company or individual to say this is a potential partner for me? Because I think a lot of people can use a lot of help on this.
Well, I think there's kind of like the basics that I would say for any type of partnership, right? You want to make sure you invest with somebody that has a clear track record, that they've done something in real estate, ideally what it is you're investing in, and they've done it, successfully. Maybe, or, if they just got into it in this past 3 or 4 years and didn't have a successful exit, that they learned and they've modified their systems. And there's perceived transparency and then there's real transparency. Just because you get a cool flashy deck and some nice emails and a video every now and then, I'm talking about they're sharing the financials with you
Yes.
and walking you through the financials. And most passive investors I talk to, they're like, Whitney, I'm passively investing because I don't want to look at spreadsheets. I do that for my job. I don't want to do it. No, okay, maybe you don't have to look at the spreadsheets, but that you're at least getting them, and you can maybe sit down with your CPA, sit down with your financial advisor, real estate attorney, and dig into the financials. I always encourage people to be actively passive. Those are some core things there. I would also say somebody that can communicate a clear message consistently and persistently, and
Yes.
that can work through uncertainty. I mean, I want somebody that can like handle those small things and the big things, the
Yes.
market, the things that we can't control. And
Yeah.
so, how do they deal with uncertainty? So, it's not a matter, can they avoid
Yeah.
uncertainty? I'm actually totally cool with somebody who's weathered a market or two, maybe, had a challenging deal. Maybe they had to sell neutral or a slight loss, but they maintained as much equity as they could for their investor in
Yes.
order to live another day, right? That's
Yeah.
Warren Buffett's rule number one. Don't lose money. Rule number
Yep.
two, rule number one. Like, how do they respond in that type of environment?
It's been pretty interesting to your point is the transparency. And one of the things I always tell people, one, you want to verify the financials, someone that have experience with that type of asset, and you want to know that this person or someone in the team is participating in that type of asset and they have the experience because to your point when it comes to do not lose money, the experience with that asset and their ability to stay true to the deal, always looking for the best outcome possible becomes critical. And I have been in the side where I have like deal with a couple of challenges, as you mentioned, in the deals is the reality of real estate. So there's going to be always an issue, a problem to resolve. That's why it's not as easy as people think. But if you have your systems in place, if you have the right partners and they match the ability to take things to the finish line, you want to keep those partners forever. You want to get married. But I think I always tell people I have a good friend that told me, Jen, if you really want to evaluate partners and who you want to deal with, my first step is play cash flow with them and make it very difficult. I'm like, that's brilliant, right?
Hmm.
We can play Monopoly. And I'm like, let me test this person and let's change the rules of the game a little bit to start finding out how they will react. And it was so easy to separate the ones that were on their own for the ones that were in the best interest of the entire game, right? And the table. And I'm like, huh. So that was my first rule. And then after that, to your point, the transparency, can they communicate clearly? Can they set aside emotions? Because sometimes that's one of the biggest challenges. It's like, I feel offended, I feel this, I feel that. It's like, okay, what is the solution? And sometimes it's that combination of being empathetic and factual, finding that balance with the right partner, communicating properly, acknowledging and taking your skills and competency together to cross the finish line is one of the biggest challenges I think in real estate. The deals are spreadsheets. And you can discuss those with the CPA to your point. So I love it. I love your insights. Now, talking about deals too, I know you pick up different assets, right? And yes, you start with rent with single family home, that you went into multifamily and you evolve into different asset types. So I have a question, and this is a personal selfish thing. How do you stay conviction driven, grounded, not just opportunity chasing, right? Because there's so many opportunities. So when I'm trying to figure out what is your internal scoreboard before saying yes to a new asset class. Let's call it that way because I love the inventor, but
Diversification is really what I was after, what I am after by getting into these other asset classes. But it's not just diversification for the sake of diversification, it's diversification because it was the right time in the market to diversify my portfolio. Between 2014 up until 2021,
Yep.
the tide's going up, like the tide is rising, like all the assets are being lifted, by low interest rates, a lot of quantitative easing still in the system. We have high valuations of assets. We haven't seen the hiccup of a pandemic or conflation of high taxation and, insurances, right? If we're looking at the four parts of the market cycle, we're coming out of the recovery of 2012, going into the growth cycle and even the hyper supply growth cycle of many different asset classes in real estate. I started off in residential real estate, moved right immediately into multifamily. I'm like, what do I know? I know residential real estate, so let me stick to my guns there. But that's where the power of partnership became even more magnified because I'm good at residential real estate. Could I learn self-storage? Sure, but now I'm taking the eye off the ball. So now I've got to partner with people I'm bringing my expertise of being able to raise capital and manage investors. Have the operational expertise. And
Yep.
so that's how I started diversifying my portfolio. Now, I learned a very important lesson. I just saw cap rates starting to compress towards the end of 2019. We all did. All my partners did. Our underwriter was like, guys, adjustable rate mortgages, they cut both ways. So he's starting to wave a red flag. And we kind of were like looking at him like, you're crazy, dude. Like, what's going on here? It's 2019, right? 6 months later is COVID, right?
Yeah.
You just don't know what you don't know. Anyways, I was like, wait, well, let's assume he is right. And cash flow compresses, distributions pause. What happens to my portfolio? I have no cash flow.
Yep.
What do I need to? I was like, this whole structure of diversification across asset classes, operators, markets, and deals does not hold water.
Yep.
I'm missing diversifying into different parts of the capital stack.
Amen. Hmm.
So that's where I start getting into, dabbling in notes and note funds, debt funds, and then, have really doubled down, for the last 5 years in building out the part of my portfolio in the debt fund. But I was like, I am missing this cash flow part of my portfolio. Let's put it this way, stocks, it's the bond to the stock.
Yep. I love that.
Right? Which actually doesn't hold true anymore because stocks and bonds are now highly correlated. But okay, you get that, right?
But
Like,
I
people
got
get that
that.
analogy. So that's now I'm sitting here going, okay, I've got asset class, market, deal, operator, different levels of the capital stack. I am really starting to see how I'm going to be bulletproof into the next recessionary cycle because it's not a matter of if, it's a matter of when it
When?
happens. Whenever your equity deals compress, because they will,
Yeah.
that's the part that is going to give you cash flow.
Yep.
But what do most investors think? They're like, well, I need tax benefits. I need every dollar I invest to kick off, not only to preserve my capital, but to kick off cash flow, equity, and give me tax benefits.
Yep.
I'm expecting too much. It puts me in the highest risk, highest reward part of the capital stack. But when the markets compress, that's the first dollar to be lost in a
Yep.
deal.
Yep.
So how can I protect some of my dollars and maintain at least the capital preservation and the cash flow part of my deal and allow my other investments to tax shelter that cash flow that I'm bringing in?
When I went to college, and many people don't know this, I actually got my life insurance license to pay for my engineering degree. And I learned a lot about annuities. And I'm like, even if I just put $20 every month and it goes to something like this, it will help me out. And the more I learn about real estate, the more I learn how you can leverage these accounts to protect your capital stack and even use yourself as your own bank while containing, or let's call it like this, controlling the taxation portion while maintaining the different. And to your point too, I love the play on what I call the trifecta of real estate: paper, cash, and property. If you learn how to play those at the different timelines with any type of asset, because to your point, finding the best partnership, the best experts on that asset allows you to know what if something happens in the market, what tends to impact these assets. And then you can prepare. Not that you can always have 100% the answers, but it allows you to know, okay, here I'm strong, but if there's like a market compression, my portfolio gets squeezed and then I don't have cash flow. I don't know if you know who is Howard Marks.
Mhm. Oh yeah.
He's one of my favorite guys. He has these book that it was like amazing, and even Warren Buffett give him praises. Is the most important thing, and is the fundamentals, especially during a compression on the market. How do you sustain your investments? And it has to deal understanding what you just explained. So I don't know if many people will catch on that. I bet that there's going to be a lot of questions below, but it's like, how do you sustain a property during a market challenge, right? Is it cash flow? Is it equity? Is it paper? What you supposed to be betting on, right? At different times, at different asset types. And to your point, I love every single asset. I have learned so much. To your point, there's going to be diversification needed. And if you don't have paper in your portfolio, if you don't have property in your portfolio, and you understand the difference on every type of investment, the risks, it's going to be very challenging for you to maintain a very well balanced portfolio that allows you to continue to live passively. Let's call it that way. So I love your phrase: be actively passive. That
Hmm. Yeah.
was amazing. Now, what is your scorecard? How do you say yes to new asset class itself?
To a new asset class? Okay, so this is how I look at my portfolio. I back it up to one, what are my goals, my risk, my timeline, and my risk capacity. And
Mhm.
I think a lot of people conflate risk and risk capacity. So risk, I might be willing to jump out of an airplane with a parachute.
Yep.
Hopefully you're not jumping out without a parachute, but okay, with a parachute. But if I'm not willing to take the risk, if I don't have the capacity, say something happens to me and my family's totally screwed, I don't have risk capacity,
Yep.
right?
Yep.
So that's number one. The anytime I'm looking at an investment, it has to match that the goals, the risk, the timeline, and the risk capacity. Okay. If it doesn't, I need to be strong enough to say no,
Yep.
right? There are so many flashy decks out there. I mean, and it's not to say that the deal's bad. It's just not aligned with me. It's not good for me.
Yep.
So scorecard number one. Then I take a look, every time I track my portfolio, I have all the deals. But I always categorize them by a tier. So tier one, is it providing cash reserve liquidity? Meaning, can I get at that money in 90 days or less?
Yep.
Right? Two, is it providing cash flow and some level of liquidity? And then three, is it equity?
Yep.
Okay. And there's varying degrees in each one of those tiers. I'm looking at what did I set as my allocation in each one of those tiers.
Mm-hmm.
So Jen, you might be good. Somebody might be listening to this and say, Whitney, you haven't even gotten to the scorecard piece for the deal. I'm like, yeah, because I have to stick to my rules
Yes.
first.
Your investment criteria, your philosophy has to
Yeah.
be grounded.
Right. And now here's the thing. I get to violate my investment criteria if I want to, but I'm doing it knowingly, right? Like, so if the deal goes sideways or south, it's largely shame on me because, that wasn't what I should have been doing. And I'll raise my hand. I've done that, right?
Yeah.
You're
Yeah.
looking at the deal, you're like, it's so good. And then you're like, damn it, I should have stuck to my guns, right?
Yeah.
Then past that, I have my whole due diligence checklist, and I'm always measuring on how well does that deal preserve my capital.
Yep.
Again, rule number one, don't get knocked out of the game. I have had multiple deals cycle out this year that and technically due to inflation, I probably lost a couple $1,000s on, but I got my money back, right?
Yep.
Right?
Principle. Don't lose the
Principal's
principle.
back, right? I didn't
Yep.
get knocked out of the game. I lived to invest another day. So how well does it preserve my capital? And then I'm grading it on varying degrees. Cash flow, equity growth, what we already talked about what layer it is in the capital stack, tax benefits. Do I need them? Do I not? Okay. I love passive investing because you can build up this flywheel of depreciative losses and continue to use it to shelter income and capital gains and depreciation recapture. But at some point in time, I've seen investors that are logging $1 million of losses on their portfolio. And I'm like, okay, time to switch tactics, guys. Right? You're,
Like,
that's going to take a really long time to absorb all those losses. Okay. You don't get to pass along the losses, right? There's a
yeah,
step up in cases, those losses go away, and then the cycle starts over again. So let's use those, right, for other type of investing.
correct.
And then, so those are the hard things I look at. And then I'm always evaluating how well does that asset utilize leverage? Okay. Is
Yep,
it smart? Okay. Is it the right leverage tool for the right investment?
yep,
Okay. And then, of course, always evaluating the operator. Who's operating this deal? Am I operating it or somebody else operating it? Because, I need to, either I need to be the expert or they need to be the expert.
correct.
But really organize those checklists into what I call the seven wealth
Excellent.
pillars, because really that's what you're trying to evaluate in a
Yes.
deal.
But to your point, I love how simple you have break this down for a lot of investors out there because I think they need it. Have an investment criteria or philosophy. Have your due diligence at a different levels. And that due diligence needs to be break down in different wealth pillars, as you mentioned. And which you bring me, we're going to talk about your book too. But also the due diligence, as you mentioned, it includes, yes, macro, microeconomics. It includes partners and who is dealing the project, so the operator. And it includes the easy part, the numbers, the spreadsheets, and all of that. And I always say the easy part because anyone can do that job. Go and verify it. I don't say everyone can do it well, but most of the people teach how to do these things. But it's the other competence that make or separate investors investment decisions that make a difference so they can be successful.
Well, if I could stack on one more thing,
Yeah.
we're all ladies here. I mean, I would imagine a lot of us are parents too.
Yep.
I'm raising a teen right now. We talk a lot about the hot head, cool head decision making. So she's always like, Mom, why are you asking me all these questions? Like, if I go to a party, what am I going to do? And I'm like, because I want you to tell me what you're going to do in a cool environment. That way, when you get in the hot-headed environment, that maybe you remember this conversation. That's what the investment thesis is, right?
Yes.
Making and having your due diligence guidelines, they don't have to be like hard and fast rules, but like bands, like what is ideal for me. But
Yeah.
if you can establish those in a cool-headed environment, when you are looking at a deal that you're super excited about and all your investor buddies told you about, you can be like, "Oh, I know everybody said that I should do this, but I got to make the cool-headed decision. I made this decision when I was, quite frankly, not like so jazzed about the returns, right? Like I was thinking about what actually mattered to me."
Especially during this market, Whitney, this is a time where a lot of investors are freaking out. We're going to say how it is. They don't know what to do. This is where, sadly, a lot of losses will happen and a lot of investors will jump at this time. It's going to be a challenging environment, but to your point, one of the things that Warren Buffett said in one of his videos that resonated with me and it's just stick with me is practice your emotional decisions before that time comes, right? And that's what you're referring your hot head and your cold head. Make sure you're making decisions based on that emotional intelligence and create a shopping list of the assets that you want to buy because they're going to become simple to buy. When I call simple to buy, they're going to be a discount. This is the time where investors need to start preparing themselves to go and buy instead of getting so scared. But it's very challenging for a lot of investors because they make decisions based in the hype. They're going to lose money and then they're going to be very afraid to what's their next move. And if they did not create the specific step for the portfolio, then they're going to be suffering. And it breaks my heart. But to your point, This is where people like you know, come with good sounded decision. This is when I can say when investors come to me, Jen, I want to invest in your deal. I'm like, what's your experience? Okay, let me refer you to someone like this person that can help you with your investment criteria. And whether you invest with me or not, I don't care. I prefer you to make your own decision based on what you want, because that will be a better service than just taking your money. Because 10 years from now, I want that person to come back to me and say, Jen, I respect that, right? I prefer that. Talking about the future, right? You have your book Money for Tomorrow. Tell me what it is about.
Money for Tomorrow: How to Build and Protect Generational Wealth. I published it with Bigger Pockets, and it actually is the plan that, as I'm going through my real estate journey, about 4 or 5 years after I actually bought that first house, I start writing down all of my money lessons. I think this is how money works. This is how the banking system works. Oh, I'm learning this cool piece of knowledge here. And I started keeping track of everything, building out my models for myself on just like, if something were to happen to me, how would I want my husband to manage our portfolio? Then we had a child. Like if something were to happen to both of us, how would we want our daughter to like, manage our portfolio? Or even, heaven forbid, have to start completely from
Yeah.
scratch. I wanted her to have all these notes. I presented the notes in a presentation at a Bigger Pockets conference a few years ago. And they were like, oh, we need that book. And anyways, it was a ready, fire, aim moment. And they were like, do you want to write a book? And I'm like, yes. And I'm like, I don't know how, but I'll figure it out. So it's a combination of all those notes. Now, who is it for? Any investor. So it's the book I wish I had starting as an investor. Actually, I wish this was the book I had in high school to teach me about money because my parents weren't that great with money. It's also the book that I put in every one of my investors' hands, more seasoned investors' hands, especially if they're coming to me and saying, something doesn't feel quite right. I'm worried about running out of money, or I'm worried that my deals in my portfolio just don't really match my goals anymore. This is a book I put in their hands because I guarantee that they've missed a step in fortifying their financial foundation, and we need to go back. Maybe it's they're not tracking their income and expenses or their net worth. Maybe it's something basic like that, which guys, ladies, I should say, don't lose sight of that, right? Anytime you're nervous about money, make sure you're executing on the basics, right? Because that's going to give us clarity and visibility. Are we taking advantage of all the 6 major ways to keep hundreds of thousands, if not millions of dollars in our portfolio? Yes, multiple zeros there. Especially for passive investors, do we have an investment thesis?
Yes. Yeah.
Most passive investors that I work with, they were like, I've thought about it. It's in the back of my head. I'm like, no, because when we get in that hothead situation, when you're looking at a deal, you're manipulating those numbers in the back of your head. You're not remembering everything. We need it written down as if it were, like you said, Jen, a scorecard. And then we get into how do we take all of the things that we built and pass it on to the next generation? And we go way beyond just the will and the trust. But like, how do we plan for what if we don't die? How do we plan for our incapacity? How do we train our executor? How do we train our heirs to steward what we built and not blow it in the
All
next
right.
generation?
That's amazing. I mean, it makes me want to read it. And I always tell people it doesn't matter how much you know or you think you know, having someone else's perspective from a book like this, it always bring the things that maybe you forgot to write, the things that maybe you haven't think about it, and you're like, oh shoot. So I'm looking forward to learn more about your book. And I already put it on my cards when I was looking. I'm like, oh, this is gonna be fun. I'm a book geek. So you ask me about books, I can start bringing a lot of references because it's seeing the world through someone else's eyes and getting their lessons. It allows you to go further faster. So thank you, Whitney, for writing this book. So I really appreciate that. If people want to contact you, what's the best way to connect with you?
If you're interested in deals, if you're a passive investor, you can reach me at passiveinvestingwithwhitney.com. There, we can schedule a one-on-one call. We can also talk through your investing goals. I can connect you with resources to kind of fill in the gaps on your education. If you need one-on-one coaching to develop your investor thesis, we got that cool head. When we go into our next deal, you can reach me at ashwealth.com, ashwealth.com.
Awesome. Thank you for sharing that. I will make sure I put it in the link below. And people, feel free to type some questions there. We're going to be answering those questions as we get connected. So we will look forward for your questions. The more you ask, the more we can provide more value to you. Whitney, thank you so much for being with us today. We really appreciate that.
My pleasure. Thank you so much for having me on.